If you're going to effectively trade with the day trading visual basics system, you need to understand the meaning behind indicator lines. And some of them have much greater impact into decision making that you go through because of what they represent versus others that may or may not have as much impact. There's many different types of effects that take place. Divergence is one of the biggest things that occurs in the system. And when we see divergence, we usually see price reactions to it. You can't possibly do well, you could. I think the video would probably be over 2 hours long if I was going to try to do all of the lines on one video. So I'm doing a few videos to explain how and what lines represent, how they work, give you an understanding of it, and basically with that knowledge and with that understanding of the relationship between lines, you can use that very effectively in your trading. The first one I'm going to talk about is zip yellow and zip blue. And zip, if you're not familiar with the system, you know that when price goes up, for example, when zip yellow is at 10, when the price goes up, zip yellow will go up. When zip yellow is over 80 and it stays above 80, it can bounce back and forth, but the price will go up when it's above 80, especially above 90. Now, blue, it is the pair with zip yellow. Sometimes you will see zip yellow and zip blue separated by a great distance, a significant spread, let's call it. And when that happens, when those two come back together, by the time they get there, there's going to be a significant price movement because of the separation. This is also why we recognize, for example, red peaks and red spikes. The basic definition of a red spike is that zip red is under 50 and zip yellow is above 50. Now, you can have zip red down to 0. You can have zip yellow down to 35 or even 30, and still it will go up the next day, not gap up. Red peaks and red spikes are just like all the other indicators that we have. They're reversal signals. Red peaks and red spikes are one-day patterns. They're good in their response for one day. The reason why red peaks and red spikes work so effectively and we see them so often is because of that understanding of zip yellow, with the idea that when zip yellow is traveling even above the 50 line, price can go up. It works a whole lot better if it's higher. But there is great flexibility in the pattern, and by that I mean with zip red going down at 5, down to 5, zip yellow can be at 85 going down, or it can be at 30 going down, and the reversal takes place. Remember, day trading visual basics is built on one premise, and that premise is reversal recognition. We identify cycle tops and cycle bottoms. We have made it a goal, if you will, of the system to work on identifying those price changes, reversal patterns, whatever you want to call them. The system is built on indicator line length differences, which is the primary method for identifying strong pressure or strong forces, market forces, in the stock at that particular point in time. The biggest moving indicator is zip red. It goes, 30, 40, 50. I mean, I've seen it go up over 90 points in one day. That indicator line length tells us a lot. But the position that zip yellow is in also tells us a lot. And that's why, since we know that when prices are going up, zip yellow and blue typically travel above, let's say, 70. If it's in the 80s and 90s, it's much, it's much more probable to continue. Obviously, at some point, you'll see a signal that it'll be going down. But the zip red, it can easily drop 50 or 70 points. And so what you see are these big spikes in zip red going down. Zip yellow holds up because the price is going to continue up. And next day, red goes back up high. It could go back up above the 50 or back into the 80s or 90s. So there's a lot of money that can be made just using zip red spikes and zip red peaks. They're reversal patterns, just like almost everything else is in the system. Price barometers. We have 5 price barometers in the system. Zip pink, swing Zion, and the 3 price line, green, red, and blue. Those 5 lines track the price wherever the price goes. If the price is up, all those lines are up. That is very valuable information if you need it instantly and to make decisions, no matter what chart you're on. And those price barometers are, because they are price barometers, we watch them a lot. We want to know where they're going and seeing what they're doing. We also identify with the big 3. Now this is trend red and power red and swing Zion. And we don't understand the forces behind those 3 indicator lines, but we do know that when those 3 are all down at the same time, all lowest, the reaction is going to be a reversal going up, and typically the big 3 ends up in an uptrend. 2, 3, 4 days, maybe 5 days of prices going up. You might have one red candle day in there. Those, the big 3, you can have one of them being a leading indicator. For example, trend red and swing Zion are down and power red goes up. Or trend red and power red are down and swing Zion is going up. Those are leading indicators. That one going up is in essence a leading indicator to what's going to happen tomorrow. You can also see trend red in low angle down, and you know from your shape patterns, your visual shape patterns in your market, in your 22 market force recognition indicators, or even from your 7 shape patterns in the proximity group, the power 4 or power 5, you know those pattern shapes. Or if you don't, you need to look those up and make copies of them and look at them and just become familiar with them. You need to understand when I say a BOC is a bottom of cycle. and when it's higher or lower. And because that's an indicator, the indicator line length on a BOC higher pattern means that the right leg is higher than the left leg, which means we have more strength in the market. There's many different ways to identify strength and see the pressure, and you can see it ahead of time. You can see it in the reaction of the indicator. There are many different forces within the market. We don't have names for them, but we can see them move on the indicator lines. And as a result of that, we can identify those market forces. For some reason, the combined market forces that are identified within Trend Red, Power Red, and Swing Zion at the same time, when they're all down and in a lowest pattern, they're going to reverse and go back up, and it's usually an uptrend, 2 to 4 days. Likewise, if they're highest, all three of them are highest, there's going to be a turnaround. It's going to the values of the price of the stock is going to drop. And so those powers that are reflected in those indicators that we call the big three is a very effective way to see uptrends and downtrends. And I make that distinction. If I say next day up or next day down, that's a one-day movement, or the idea of you gotta at least have a one-day movement. When I say uptrend or downtrend, the indication is that the setup is likely to last for more than one day. You have to check it as you continue through each of those days, but the indication is when you have those big three movements that it's a multiple day reaction. The deep cycle indicators are Swing Gray and Power Pink and Blue. I treat them as two different deep cycle indicators. Swing Gray is by far the best. When Swing Gray is going up and above zero, you are going into a high cycle, and when it reaches its peak and comes back down, you're starting going down. When it goes under zero, you started in the low cycle, and then when at the low cycle, it'll get into a BOC pattern and come back up. And so, just one FYI. If you have a pattern that's divergent to its condition, and by that I mean if you have a BOC pattern in Swing Gray when Swing Gray is above zero, you're usually going to get a strong reaction, and that reaction is typically to go up. But there are some situations where it's a power move in a strong down movement, but that's not for this video. The pink, the Swing Gray records it's really accurate in its cycle top and cycle bottom determination. On some occasions, it can be it's a slow-moving line, so it can have a one-day delay. But oftentimes, it just as many times did not. When the cycle changes, the gray line also changes. The other thing too, when you have an opposite pattern, like when you have a Swing Gray going down, and you get a TOC pattern. In other words, the TOC should be at the top, not in a pattern going down. When you get a TOC movement under zero in Swing Gray, it's a strong indication of a price movement. And normally that's again going back up strongly. But verify that when you're looking at it. And the reason I mention those two is because it's basically a divergent condition. You normally don't see a TOC pattern at the bottom of a cycle. It's just not normal. And what it basically is the market has pushed the price down beyond what is normal as far as equilibrium is concerned. And so the reaction then, in simple equilibrium terms, is to push back in the opposite direction. And so the DTVB system is basically designed to see strength. We have emphasized the ability to identify market strength, and you can, a BOC higher indicator line versus a BOC lower indicator line is an identification of strength. The higher pattern is the BOC pattern is the first day of the turnaround. We can, on the first day of the turnaround, a BOC higher pattern typically tells us that there's going to be much more upside to this movement. When you get a BOC higher pattern on a peak, what has happened is that the traders have pushed the price of the stock beyond what is normal, again from an equilibrium perspective. And so what's typically going to happen is it's going to go down. The next day it may gap up and then go down, but it's still telling you about strength. And those are the key things. I'm guessing 25 to 40% of the indicators each day you're going to be able to identify strength. You can't do every stock every day, because there's a lot of stocks that are just moving in a continuation pattern or in smaller strength movements. And those, of course, we aren't necessarily interested in, because we want to identify those that are going to have more volatility. There's going to be bigger ranges. In other words, bigger difference between the high and the low trading values of the day. And that range value to us is important. And so the back to the deep cycle indicators, swing pink is a short cycle. In other words, you might have a strong upcycle taking place and you get a pullback. And pullback is probably not the right word. You get, but that idea is there. The trend red and those fast lines are going to immediately identify pullbacks. But pink is going to identify small trend changes within a long-term movement. And so power pink as a deep cycle indicator, I usually say power pink, but it's also power pink and blue, and power pink and blue are interchangeable. You can have power blue at the bottom in a BOC pattern or on that turnaround, and it's best when it's lowest. And when we consider power lines, we exclude power red when we say power pink is highest, or when power yellow is highest. Remember, there's a lot of power. There's a lot of influence in our ability to see anticipated price movement in those indicator lines. The twin yellows, that is power yellow and zip yellow. When they're both lowest and going up, you have an uptrend. And just because one of them gets buried under some of the other indicator lines does not mean the uptrend has stopped. It just means that the pattern recognition has stopped. We can't say that after the lines get buried that the trend is going to continue in that direction. If zip yellow and power yellow are highest and going down, you're in a downtrend until one of them disappears. But again, it can still continue. It's just like Zip Zion. When it's lowest and going up, you're in an uptrend. And when it's highest and going down, you're in a downtrend. And especially with Zip Zion, you can identify with the continuation of the pattern, even though it disappears. And as long as I'm on that topic, Zip Green and Zip Zion are both indicators that track buyers in and out of the stock. When Zip Green is at 0, traders are leaving the stock. When Zip Green is at 100, traders are entering the stock. Zip Zion is like a grandfather to Zip Green. It takes a lot of push to keep Zip Zion at 100. When it's pushing the extremities of either 100 or 0. When Zip Zion is at 100, believe me, there are a huge number of people selling out. That's powerful information. Match that with Zip Pink. You have a price barometer, and so there's a powerful pattern that many people deal with, and it's called the pink-green tops and the pink-green bottoms. And Zip Green will travel at 100 for 1 or more days, and Zip Pink is right next to it. And so what you have are the people buying into the stock, Zip Green, and the price of the stock, Zip Pink. And Zip Pink in a normal situation, I mean the vast 90+% of the time, when Zip Green is at 100, Zip Pink will be close to it and going up. The Zip red, gray, yellow, and blue lines will bounce around in different places, as well as Zip Zion. Oftentimes when Zip Zion hits 100, the first day, when it hits 100, it reacts and goes back down. The value of that stock goes back down the next day. That's not always true, but that happens an inordinate number of times. Your leading indicators: Zip red and gray, pink, swing pink, and of course the power 4 lines. That is pink, blue, white, and yellow. If you take the yellow out, you have the power 3 lines. If you add power Zion to the power 4, you have the power 5. And when we're looking at location patterns for the proximity group, we are looking at primarily at power 5 because we want the divergent relationship between the power 3 and Zion or the power 4 and Zion. And there's 2 types of divergence. When power Zion is under power orange, we have a divergent condition. If Zion is above power orange and the power 4 are under power orange, we also have a divergent condition. That's referred to as location divergence. The other type of divergence is when Zion is down and power 4 is up, or maybe the power 3 is up. That is directional divergence, or the line itself is going in opposite directions. And when that happens, we get a reaction in price. And so if you're searching for gaps, there are 3 gap patterns that we use exclusively as a vast majority of the time. Those are the identical indicators, the 22 market force recognition indicators that are in the 5 charts. And those represent the pressures or the forces within the market that moves. And you'll see one indicator will go up and the other indicator will go down. Excuse me. And as a result of that, you get divergence. Now, there are dozens and dozens of different types of divergence. But the the key thing to remember is that when one indicate, and let me give you an example. You can have a right leg W in a longer, in what we refer to as a large pattern. In other words, in a 4-day pattern. You have a bottom left leg to the W, and 4 days later you have a right leg down that is higher, and that's a right leg W higher. So that is a large. You can have 5-6 day right leg W's or even 10-day right leg W patterns. Those are large patterns. They don't necessarily mean there has to be supporting evidence that goes with them in order for the reaction to take place, in order for the gap to take place. But those patterns can be significant in identifying gaps as well. Now, sometimes you can have, for example, you can have you can have zip red and gray travel together. Zip gray and red spike down, and zip gray is just under it. When 4 days later in a right leg W, zip gray is above red, and that's a divergent condition. When gray was under on the first left hand W and above on the right hand W. When you get divergence like that, it's a significant indication of a gap. And there's all kinds of examples like that. They can occur in one line or 2, 3, 4, 5, 6 lines out. They come in high M patterns, they come in right leg W patterns, they come in BOC patterns, they come in BOC 2-day patterns, or TOC and TOC 2-day patterns. The emphasis is to spot the divergent differences. One of the most powerful divergent differences is your trend red in a divergent condition with power red. Those are two of the big three, and they somehow record a lot of power and different types of power within each line. And so when, for example, a right leg W, we look at it as a 4-line consideration primarily. It's down for forming the first bottom of the W, the left-hand side of the W. So it goes down, up, down. It's a 3-day pattern, and the right leg of it is higher than the left leg. The right legs are much more powerful than right leg W lower. But when you get many indicators, some of them are right leg W higher and some of them are right leg W lower, that's divergence again, and that will typically be a strong gap up. The right leg W patterns are gaps up. High M patterns are gaps down. And when you have divergence, especially when you have it in price, like when price red is highest on the left high M peak and lowest and lower than green on the left high M peak, you have a significant divergence. And think what you have divergence in. Those two lines are recording price. And so it's a very powerful divergent lines to consider. I mean, some lines for divergence are much more valuable than other lines. And so you think about the lines that you're looking at most. And when I'm commenting on them on videos like this, those are the lines that are most important. The next group that I want to talk about is the 7 short-term trend lines. And these are the trend trio, they're in 3 groups. And that's the yellow, pink, blue line, and they will pass over. If you've looked at any chart, you've seen how they stay together and they move up or move down under 0 or above 0. That's the first group. The second group is the power green and orange line, and the third group is the swing red and green line. On the master chart, when you open up the platform, they're drawn in as wider lines. You obviously do not have the ability to change color on the master trend chart, but you can change the width of the lines if you prefer different widths. You can just go in there and do that. And that's an optional thing on TradeStation. But of course, the functions that drive the indicator lines as names with colors, those we cannot change. Though now, background information. When we created the long-term master trend line, which is the blue dash line in the candle chart, that is a exponential average line that we used to create that thing. It took a fair amount of time to determine that this was the best long-term trend line determination. What do I want to say? The factors that we use to create that line, and the reasons behind it. But this is the line that we created, and we tried to do that with the short-term trend lines. In other words, what I'm saying is we tried to have one line that would identify the short-term trend, but it just got to the point where it didn't make sense because we tried many different varieties of methods, and it just became a lot more easier for us to create the three groups: the trio group, the power group, and the swing group. And we didn't see it at first, but it's actually been very advantageous for us, or for the trader, because of the differences in the lines, because you can oftentimes see the trend trio above zero while the other two groups are under zero. The trend trio moves faster than the other two groups of short-term trend lines. Now, it's very important to understand the short-term trend lines. You have the 22 market force recognition lines, you have the 7 short-term trend lines, you have the special use lines, swing gray and swing blue. Swing blue is primarily a crossover line used with swing gray and green. When swing blue crosses over swing green, it's the start of an uptrend, but it can be a weak start. But when swing blue crosses over swing red and travels above swing red, you're in an uptrend. Now, swing blue is slower than swing yellow, and so not that you can use those lines to determine movements, because you always want to use your fast lines like zip reds, swing pink, trend red, and power red. When you're trading, you're always looking at the big three. Those are possibly the most important lines to look at. Trend red especially. The strength of I've got the 22 market force recognition indicators, the 7 short-term trend lines, those 2 special use lines, swing gray, which is your deep cycle indicator, and your swing blue, which is that crossover indicator line. You then have 4 bands in the candle chart with upper and lower lines. You have the master long-term trend line. Totally, we have 40 lines built for the entire system. But the heart of the system is the 22 market force recognition indicator lines, MFR. Those tell us about the pressures in the market. They tell us about the market forces within the stock. They give us that information that is so valuable. When you put all of this information together, one of the first things you look at when you let's say you ran a few scans, or you ran a scan and you got a few indicators and you wanted to compare 3 or 4 of them. You're always going to look at the short-term trend lines first. Also remember, when, for example, trend trio is above zero, it is a whole lot easier. It takes less force to drive price higher. And when trend trio is above zero, price tends to go up, even when it's running flat for many days. There's another key theme that you need to understand. For example, let's take power orange and green. They can be above zero or under zero, and they can be going down or going up. When trend orange and green are above zero and going down, I'm just, not that they have this, but I'm going to say this. The power green and orange drive the price down. That's not exactly true, but just think of it along those ideas. Green and orange are driving the price down. They're above zero. Their ability and the power that they have when the lines are going down and when the lines are above zero are not as strong as when they are going down and they are under zero. So in other words, when they're going down and under zero, they got more power to continue the downtrend. The opposite is exactly the same. When the power green and when the power orange and green lines are going up and they're under zero, they're weaker than when they're going up and above zero. They have a tendency to be able to push the price higher or deeper or higher or faster, or there's more volatility, or however you want to think about it. Now, that is true with many other lines. That theme or that strength relationship in the lines of when it's above or zero, just like power red. Power red is your position, your biggest and most powerful position indicator. When power red crosses over zero, it has the ability to drive the price up. And oftentimes you'll see a nice green candle when power red crosses over zero. And you'll see a nice red candle when power red crosses under zero. You'll see a nice green candle when the power 4 all cross over the zero line. And oftentimes when power yellow by itself crosses over zero. All of the power lines have a hint of positional indicator effectiveness. In other words, when they're above zero, the price tends to go up. When they're under zero, price tends to go down. When you're looking at the when you're looking at the 3 gap patterns, your identical indicators, when you have 12 or more in 1 or 2 groups or 3 groups, you have a majority of indicators in one of those patterns. That's one of the things that you have to have for a gap. The other thing that you have to have for a gap is a down touch in the trend chart for a gap up. You have to have an up touch in the trend chart for a gap down. I'm going to say 75 to 80, maybe 85% of all up touches and down touches occur in the trend chart. But there are other valuable up touches and down touches in all of the other charts. The one touch in the trend chart, the trend red, green, and gray can down touch the 3 trio lines, yellow, pink, and blue, or those 3 can down touch 0, or the trend red, green, and gray can down touch under 0. The key is that the red has to cross over 0 on that day, and then the next day it gaps up, goes up, not necessarily gaps up. But it qualifies as a down touch. That's what I'm trying to tell you. And there are 5 different places or 5 different lines that we can use to qualify down touches in the trend chart. So you've got the identical indicator qualification, you got the down touch qualification, and you got the proximity group power 4 or power 5 qualifications. And those come in two categories: location patterns and shape patterns. The shape patterns are just like the visual shapes in the 22 market force recognition indicators, the BOCs, the TOCs, the bottlenose patterns, the high M's and the right leg W's. Those are all the same. There's a little bit of difference in the 7 proximity group shape patterns, but it's not that much. The distinction, or it's easy to identify the 22 market force recognition indicators as being in one pattern group or a 2 pattern group or a 3 pattern group. It's easy to see down touches. You can see when trend green down touches trend pink. You can put it on a scan. That's one of the primary ways we find opportunities. We work with the 330-minute chart or scan. We run those scans an hour or an hour and a half before the closing bell, and we find our gaps. The power shapes tell about the patterns. You have to have the pattern, but the power 4 proximity group location patterns are the most important. The difficulty that some people have in understanding this is there are probably a dozen patterns in which you can find the location pattern that is acceptable for a gap up. That's not, but keep in mind, you have to have all 3. You have to have the identical indicators, more than 12 of them. You have to have the power group down touch in the case of a gap up. And the one difference in all of those, I forgot to mention, was the trend red. We call it the trend red and green sky touch. That's typically when trend red and green are 3 days up, and they don't touch a line, except we think of it as them touching the sky. And so when you have a trend red and green sky touch, and you have the power 4 location patterns, one of a dozen different patterns, those then, especially if you have some supporting other evidence, like zip Zion up and lowest, or you have a red spike, which would tell you that the next day it's going up. When you keep adding all of this information to the 2 primary movements, the trend red sky touch and the location patterns, you then have a good conditions that will typically drive a next day gap up. Now, those locations are described in the location pattern index, and they're basically, you've got zip Zion under power orange, and you have the power 4 above power orange. Remember, all divergence is between power orange line. When you think of power orange price changes, it's above or under 0. But when you think of the power 4 divergence or power 5 divergence, it is under the power orange line or above the power orange line. You can have the power 5 all above power orange. You can have Zion down and the power 4 up when they're all above orange. You can have the same thing when they're all under orange. You can have the power 3 above orange and zip Zion under orange. When you have both types of divergence, when you have zip Zion under orange and the power 4 above orange, and you also have zip Zion down and the power 4 up, you then have a double divergence, and those are usually supported or usually identified with other supporting evidence information and can cause really nice gaps. So the difficulty with the power patterns or power location patterns is that there are a dozen different locations, is what I'm trying to say. You have several different locations with power yellow because power yellow moves independently. Sometimes power yellow can be under power orange, and the power 3 can be above it. Yellow runs independently. You know that from the yellow twins, when power yellow and zip yellow run together. When they're lowest and going up, you are in an uptrend, and vice versa. So those are ideas that I wanted to convey to you. There's obviously a lot more, but these are the primary ones that we spend a lot of time at. There are a lot of other things with different indicator lines that can be shared, but I'm not going to do it on this video. I don't want to get it too long. Grateful for you looking at the video. I really encourage you to increase your knowledge. Our goal at DTVB has been to help you become a knowledgeable, independent, confident day trader.